We gon' make it. 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 Hey, what's up, people? It's your boy Trader Guy. Tonight here on a Friday night. I could go out, but I said I'd rather do a podcast tonight. Tonight we're gonna talk about banking. Banking 101, as a matter of fact. And we're talking about, the differences between the bank accounts and which accounts can be used to invest in the market. Because there is a few bank accounts that are linked to market performance. It's sort of like mutual funds. All right, people, let's dive right into the lesson. All right, so the first account is the basic checking account. It's the most flexible type of bank account. You think of a bank account as a house. We're gonna use a house metaphor throughout this video, okay? So you think as a bank account as a house, it's for your money to hang out till it's ready to be used. So for a checking account, people are always in and out the house because you get your paycheck deposited in and use that to pay your bills. So they're constantly in and out the house. One good thing about a checking account, you normally have zero to low balances. So that's why a lot of people prefer the checking account because a zero to low balance, that's not a problem for most people. So also the best thing about a checking account is that you have instant access to your money when you need it. And what's the big word we talk about, people? Liquidity. What's liquidity? Instant access to your money. So anyone who wants their money instantly deposited, instant access, a checking account is your best option because especially when you get your checking card that's attached to the account, it's instant access. Okay, now the only thing about a checking account is that they normally don't offer interest because your in checking accounts your money normally doesn't sit long enough to accrue interest. So most banks don't even bother to offer interest on a checking account because it's the useless option. All right, so number two, the other account is the savings account. Now, a savings account is a lot less flexible than a checking account, but it's a lot more profitable in more ways than one. See, the big difference between a savings account and a checking account is that savings accounts normally require a minimum balance that's a lot higher than a checking account. So that's the one upfront main difference. Another difference is, well, now I'm sorry. Then this next one is the biggest difference that since savings accounts normally have a higher balance, a minimum balance, your money is normally going to sit there longer. So most savings accounts they typically offer interest, and that's the big difference between a checking account and a savings account. That the interest rate. So basically, while your money's sitting in the savings account, it's going to make money on its own, which is the interest rates. So that's the great thing about a savings account. And continuing the house metaphor that I brought forth in the checking account, which I'm going to use continuously, think of the as the checking account, people are in and out your house. With a savings account, man, people move in your house and they unpack their bags and they stand for a while. Ain't going nowhere because they got things to do. So, and another big difference between a checking account and a savings account is that, again, in a checking account, you have instant access to your money. Whereas in a savings account, you normally get six withdrawals. It depends on the bank. I know my bank, I get six withdrawals from my savings account before I get fees. As well, like a bank charges you fees to get access to your own money. Like people, why do we put our money in banks for? That's I still go crazy over that. But again, that's that word again, liquidity. We can't emphasize that enough. In banking, financial, economics, anything that deals with money, liquidity is a big issue. All right, now the third account is the money market account. Now, a money market account is typically a savings account, but it has a higher interest rate. And they also have a higher minimum balance. So think of the house metaphor again, where it's a savings account, people move in your house and stay for a while. As a money market account, a lot of people move in your house and they're going to stay for a really long time. Again, now the best thing about a money market account, it has a higher minimum balance than a bank. Than a savings account, but the interest rate is also a lot higher. That's like the trade-off, or that's like no, I'm sorry, that's like a incentive for opening up a money market account. You put more money up, but you get a higher interest rate. So therefore, your money earns so faster, and you make more money when you put more money in the bank. So between those three accounts, I would always recommend people to have two accounts. That's what most banks give you the option anyway. Whenever you open up a checking, they always feel like a savings that's attached to the checking. That's a good option, people, because you want to have your money earn money. That's how the rich get rich. Actually, when your money makes its own money, that's when you know you made it. So and I tell people you get a savings account, but it would be best served to get a money market account because it's really like a bigger and better savings account. You know, See, a lot of people really never heard of a money market account. They're like, what is that? Well, or they probably heard of it, or they thought they needed a really high account balance, which the account minimum is higher than a regular savings account. But in the long run, you would be better off served just saving up your money for the money market account, especially when you have your checking account, which gives you liquidity, instant access to your money to pay your bills with, to incidentals, gas, going to the club, what have you, buying shoes. Yeah, Corey Miller, that's a good thing too. Make sure your bank is crypto friendly. Exactly, because especially nowadays, man, with crypto making a lot of strides. Or speaking of that, you see J.P. Morgan's opened up a crypto exchange. They're going to try to compete with Coinbase. I want to see how that's going to turn out. But yeah, but over in England, to continue Corey's point, certain banks are not even making crypto transactions. So yeah, so the fourth one is the certificate of deposit, which is a CD. Now, this is like that was my grandfather's way of saving, or my grandmother's way of saving CDs. People normally say, I'm gonna put my money in the CD and I'm gonna make money. And it's like, not really. A CD, I mean, it's good. A CD is a savings account that has a higher interest rate because the money got to stay in the bank for a longer amount of time. And that you get to choose. So the time frame is normally from 6 months to 5 years. It's basically a contract. You in the bank enter a contract. Hey man, I'm gonna put my 10,000 in this bank account for 18 months. The bank says, cool, thank you for giving me the 10,000. I'm gonna give you such and such interest rate. Like I say, like I just said, the CD was my grandmother's way. I'm gonna put money in the CD and it's gonna sit and it's gonna make money. And it's like, yeah, but there's way better options. And that's what we're going to get into next. I just want to cover those four basic bank accounts. And again, between those four, I would take a money market over a CD because the money market, you get access to your money at least a few times a month before you incur penalties. Whereas a CD, once the money's in a CD, instant one-time access, you're going to incur fees. So, yeah, the money market to me would be a better option. Now, we're getting to what I do now, the trading accounts. Or no, I'm sorry, they're not trading accounts. They're accounts that's linked to market performance. So it would behoove you to, for the people that's in the military out there, especially in the army, that's what I drill sergeant words. It would behoove you to do the research on these. You know. So the first one is the structured notes. Structured note are they're like a market link CD. So it's basically you and the bank make a contract. I'm gonna give you such and such money for a set amount of time. But they're not covered by the FDI insurance, which means honestly, this is like the worst option ever. I wouldn't be comfortable putting my money in the bank that's not covered by the FDIC, you know. But the bank issues you a note in exchange for lending this money. At the end of the time period, the bank guarantees to pay you the greater of either 100% of your deposit or a certain percent of the market gains. Like for instance, JP Morgan has a 7-year structured note with 100% downside protection, which means that, just think about it, that's self-explanatory. It has 100% downside protection, which means that whatever rate you buy into, you're locked in that rate. You cannot go down because you have 100% downside protection. You can only make gains. So, this structured note, it has its pros, but the biggest con to me is it's not covered by the FDIC. So, your deposit isn't insured. So, in the bad economy, something like this, you had a bunch of money in this bank, you might have probably could have took a hit. And before that was the last note. Remember, the note is only secure as the bank that issues it. So before investing in the bank, check the balance sheet. Make sure it's fiscally sound. I cannot stress that. Fundamental analysis. Like it's integral part of trading, people. If you want to be a long-term investor, fundamental analysis. I cannot stress that. All right, so number two is a market link CD. That's basically it's a CD, but it's a market link CD. They're similar to the structured notes, but they include FDI insurance, FDIC insurance. So this is basically the better option because it's short term. The only thing is that that the terms, the contracts are shorter. They're usually 1 year to 1 to 2 years, whereas the structured note is 5 to 7 years. But again, this is a I mean, to me, this is a way better option. Your deposit is FDIC insured, and your money's only tied up for 1 to 2 years, whereas this one is 5 to 7 years. So again, that is called the market linked certificate of deposit. So you call your bank or again your financial advisor or go to Google, anything, and check out these options because again, these are ways of pass to passively trade. Like me, I actively trade my money. See the type of account I have. I might as well be a spokesman for TD Ameritrade because I'm always co-signing. But I have a Ameritrade checking account, and I just do everything from that account. I have a money market account also, but my TD Ameritrade, I actually trade from that account. That's where my trading capital comes from. That's where I pay my print, everything from that account. But see, I actively trade. So for people that want to passively trade, that follow the market but not so much day trade, things like the structured note and the market link CD, those would be great options because those are normally linked to indexes like the S&P 500 or the Dow 30 or the Dow Technicals. Like it's so many different indexes. You know what? I think the next podcast is going to be the different indexes and how to invest in them because yes, for a beginning investor, again, if you don't want to day trade or sometimes you don't feel like doing all the research, a market link CD or a structured note would be a that would be a great option. Or, like I said before in the previous podcast, mutual funds, diversification. But yes, people. So yeah, I feel like people should know where their money's going to because, even though I talk about trading a lot on my podcast, at the end of the day, fiscal responsibility is a big part of everyone's life. If you know where your money's being spent, or I'm sorry, how your money's being spent, how your money's making money, which ways your money can make money, I think people will be a lot better off because at the end of the day, man, every cent count. That's how it is in my life. I really track I try to track. So I think if people knew the different accounts, the different ways to invest, different interest rates, because again, certain banks offer 7% interest rates, some offer, you know, six. Like I just seen commercials, so if you want to just put your money in a savings account and let your money just sit, because this thing, if the bank only offer 1% interest rate and you put $10,000 in a savings account, at the end of the year, that's $100, and then you have $10,100. Think if the bank had 5%, say 3.99%, just that would be a good thing if you would prefer to just put your money in a savings account and allow it to sit. So yeah, there's always options, people. Always options. Like I say, me, I just have money in a checking account. Liquidity. That's the big thing in my life. I want instant access to my money. What's the commercial? JG Wentworth. It's my money and I want it now. And I want it now. Like worst thing about the checking, I'm sorry, savings accounts and the money markets accounts, only get I know for my check, for my savings account, 6. For my money market, I think it's 3. Before I get charged fees. Like that just I cannot understand that. They give you fees for access to your own money. But until somebody come up with a better way to bank, we're just gonna have to deal with that. So that being said, you should compare banks. Always you want banks with strong fundamentals because even though a bank could be a good bank, it could be in debt, you know, and look for mergers. You want banks that offer different access, different accounts and different ways to invest your money. You just don't want a bank I just want people to understand that the old fashioned way of throwing your money in a CD and just getting interest rates, there's so many more ways. Like I just covered, you have market linked CDs, which is a that's way better because it's a CD, but it's linked to market performance. So, for instance, if you would have had a market linked CD to the S&P 500 within the last 5 years, that was the biggest. Well, I mean, we can go back longer, like since 2012, but I'm just basically what I'm trying to explain is the S&P just finished off the biggest bull run in world history or American history because it's an American based index. So if you would have had your money in the regular CD compared to a market link CD, it's not even a comparison. It's like you really can't compare people. So again, I just want to stress the fact that the old-fashioned way of throwing your money in the CD is not as back in the 70s, the 60s, the 50s. That's your grandfather's way of investing. That's your grandmother's way of saving. There's better ways than that, people. And on that note, we're gonna keep it short and sweet tonight. It's Friday night. People go out and enjoy ourselves. Just want to give you a quick little podcast on banking. Other than that, man, it's your boy Trader Die. You know the theme song always. But yeah, catch me on TraderDie.life, TraderDie.life at YouTube, at TraderDie.life at Gmail. Man, hit me up, man, with your questions. And other than that, man, have a good night. Friday night. Holla.